Trade like a professional, not a gambler. Most people enter the market believing they are about to make money. What they're actually doing is providing money to someone else. That sounds harsh, but markets are not designed to reward hope. They reward discipline. They reward preparation. And they punish randomness. If you trade without a system, if you enter because of feeling, if you buy because someone on social media sounded confident, you're not trading. You are gambling. And eventually, gamblers run out of luck. We're going to discuss 5 trading principles that separate professionals from amateurs. These principles are simple, but they are not easy. And if you master them, you will already be ahead of most people who have ever opened a trading account. Imagine opening a restaurant without knowing what food you sell. Imagine starting a construction company without blueprints. Imagine flying an airplane without instruments. This approach is clearly impractical. However, many traders enter the market each day without a defined process. They buy because a stock looks cheap. They sell because they feel nervous. They frequently switch strategies. As a result, they are often surprised when their account balance declines. Professional traders know exactly why they enter a trade. They know exactly where they will exit. They know exactly how much they can lose. They establish these criteria before risking any capital. A trading system does not need to be complex. It simply answers 4 questions. What do I buy? What do I buy? When do I sell? How much do I risk? If you cannot answer these questions precisely, you do not have a system. Without a system, every trade becomes an emotional decision. The market favors emotional traders. They are the most vulnerable to losses. Many new traders tend to become collectors. However, they collect indicators rather than profits. Of indicators, they add moving averages, RSI, MACD, stochastic, Bollinger Bands, volume, custom, and even so-called secret indicators to their charts. Despite this, they often wonder why their results do not improve. The reality is often uncomfortable. No indicator can compensate for poor risk management. Losses are inevitable, whether in individual trades, weeks, or even months. You will have losing weeks. You may even have losing months. This is a normal part of trading. The key question is not whether losses occur, but whether you can withstand them. A trader who risks 10% of their account on each trade will eventually lose their capital. In contrast, a trader who risks only 1% per trade can survive many mistakes. The difference lies in survival. Survival is essential. If you remain in the market long enough, you can continue to learn, improve, and eventually become profitable. However, if you lose your entire account, your trading journey ends. The market rewards those who manage to stay in the game. It does not reward those who seek quick riches. Keep this in mind. A trader's primary responsibility is not to make money. The first priority is to protect capital. One of the costliest mistakes in trading is assuming your opinion outweighs the market's. It does not. The market is indifferent to individual opinions. It is equally unaffected by the views of economists. The perspectives of television experts also have no impact. Ultimately, price reflects the market's collective decision. Many traders attempt to buy every decline during a downtrend. They often reassure themselves. It can't go any lower. Yet the price continues to fall. It declines further and continues to drop. Others attempt to short strong uptrends simply because prices appear high. They continue to anticipate a market correction. Meanwhile, the upward trend persists. The prevailing trend has a greater impact on your results than individual analysis. When the trend is rising, seek buying opportunities. When the trend is falling, adopt a defensive approach. If the market is moving sideways, adjust your expectations accordingly. These principles may seem straightforward. However, simple guidelines are often overlooked. The path of least resistance typically aligns with the prevailing trend. Fighting that reality is like swimming against a powerful current. While it's possible, it requires significant effort. Ultimately, the current prevails. Many beginners focus on the wrong question. They ask, how often are you right? Professionals ask, how much do you make when you're right? These questions are fundamentally different. Imagine trader A wins 90% of the time. This may seem impressive, but every loss wipes out 10 winners. Trader B wins only 40% of the time. This may appear unfavorable, but each winner is 5 times larger than each loss. Trader B becomes wealthy. Trader A eventually blows up. Frequent wins can be satisfying. However, generating consistent profits is more important. Markets tend to reward asymmetric outcomes. Minimize losses. Maximize gains. This approach defines successful trading. Success does not depend on prediction, nor does it rely on certainty. It relies on asymmetry. If a trade moves against you, exit promptly. Accept the loss. Move forward. Do not attempt to negotiate with the market. Do not hope. Do not pray. The market remains indifferent. When a trade moves in your favor, allow it the opportunity to grow. Use trailing stops. Stay patient. Let profitable trades become significant. A few substantial gains can transform annual performance. Trend followers have used this approach for decades. They are frequently incorrect. However, when they are correct, their gains are significant. Many investors confuse information with timing. These concepts, however, are distinct. Fundamental analysis remains a critical component of investment evaluation. Such analysis assists in identifying high-quality businesses. It also provides insight into long-term value creation. However, fundamental analysis alone does not indicate optimal entry points for investment. A company with strong fundamentals may experience a significant decline in market value. Conversely, a company with weak fundamentals may see its share price increase substantially. Market movements are primarily driven by the forces of supply and demand. These dynamics are ultimately reflected in a single metric: price. Price represents the objective reality of the market. All other assessments are subjective interpretations. A company may report record earnings. If the share price declines, selling pressure dominates market activity. A company may receive adverse news. If the share price increases, buying pressure prevails. For this reason, investment professionals monitor price action closely. Market movements frequently anticipate information that is later reported in the media. The most favorable investment opportunities arise when fundamental analysis and price trends are aligned. A robust underlying business, a sustained positive trend, significant market momentum. The combination of these factors can yield substantial investment potential. When both the fundamental narrative and technical indicators suggest the same outcome, alignment is achieved. Such alignment often generates compelling investment opportunities. Many people assume that successful traders have access to secret knowledge. This is not the case. Most professionals excel by consistently following established rules. They manage risk. They follow trends. They cut losses. They let winners run. They stay patient. Most importantly, they remain emotionally detached. The market is not a test of intelligence. It is a test of discipline. The smartest person in the room can lose money. The most disciplined person often wins. This idea surprises many people. Most beginners assume that successful traders possess extraordinary intelligence. They imagine that professionals have superior predictions, secret formulas, or access to information that nobody else has. The reality is often much simpler. Markets are filled with highly intelligent people who consistently lose money. They know economics. They understand accounting. They can explain all chart patterns and financial ratios. Yet many still fail. Why? Because knowledge alone is not enough. A trader may know exactly where to place a stop loss. Discipline is the act of placing it. A trader may know that risk should be limited to 1% per trade. Discipline is adhering to that rule, even after a series of losses. A trader may know they should wait for a quality setup. Discipline is resisting the urge to trade simply out of boredom. The market constantly tests human emotions: fear, greed, impatience, overconfidence, frustration. These emotions often lead individuals to abandon their plans at the worst possible moments. They move stop losses. They chase prices. They increase their positions in losing trades. They take profits too early. They ignore risk. These mistakes do not occur due to a lack of intelligence. They occur because of a lack of discipline. Consider two traders. Trader A has a genius-level IQ. He understands every indicator. He reads every market report. He constantly searches for the perfect prediction, but he breaks his rules whenever emotions take control. Trader B has average abilities. His analysis is unremarkable. Why? However, he consistently follows his trading plan. He manages risk. He waits patiently. He accepts losses. He never allows a single trade to threaten his account. Over time, Trader B frequently outperforms Trader A. This is not due to greater intelligence. It is because he demonstrates greater discipline. This principle applies far beyond trading. Professional athletes follow training routines. Successful business owners follow systems. Elite military units follow procedures. Long-term investors follow asset allocation plans. The common thread is not intelligence. It is consistency. It is the ability to execute the correct actions consistently, even when emotions encourage the opposite response. Markets reward those who can remain calm while others panic. Markets reward those who can stay patient while others chase excitement. Markets reward those who can follow a plan while others react emotionally. Ultimately, profitable trading is rarely about discovering a secret. It is about mastering yourself. The greatest edge in the market is not a hidden indicator. It is not artificial intelligence. It is not insider information. It is self-control, because intelligence tells you what to do. Discipline makes sure you actually do it. And ultimately, markets reward disciplined behavior far more than intelligence. If you retain only one takeaway from this video, let it be these 5 essential lessons. Have a system. Protect capital. Follow the trend. Think in terms of risk and reward. Respect the price above opinions. Apply these principles consistently. By doing so, you will already surpass the majority of traders. The market will remain challenging. Losses will still occur. Mistakes will still occur. However, you will no longer be consistently losing capital to the market. You will ultimately operate with a competitive edge. In the context of trading, possessing an edge is paramount. This is because reliance on luck is unsustainable. In contrast, discipline yields enduring benefits. If you found this video valuable, consider subscribing to the Illiterate Investor. At this channel, we do not pursue speculative predictions. We build systems. We manage risk. We also strive for financial independence. One decision, one trade, and one lesson at a time.